One of the main things that people have continued to underestimate for the past 3 to 6 months is, the relative weakness that we've seen in some of these mega cap growth names, the Apples, the Amazons in the world, which in their own right, of course, are great companies, but they haven't done a heck of a lot. And so one way you can sniff these things out a bit better is by using what I call a multi-factor model, or not just looking at an absolute chart, but looking at it sort of two-dimensionally by using relative charts. So this is one of the major things that really differentiates or separates the professional investor from the amateur investor, or even, dare I say, to some extent, maybe the successful investors from the less successful ones, is by looking at things through the lens of, again, multi-factor analysis, or really looking at things more than just one-dimensional, so two-dimensional, or even potentially 3D if you want to put it that way. And a very simple way of doing that is by looking at things in relative terms with ratio charts. So let me walk you guys through why we think there's actually quite a bit more weakness to come in the NASDAQ 100 names, and how this is something that we've been able to sniff out for some time. So you can actually go back and look at some of our videos we've been posting out there on social media and different venues, and we've talked about that weakness in the NASDAQ 100. And before we even look at the ratio chart, let me just quickly show you the NDX. This is, this is the QQQs, but we could look at the NDX. It's the same thing, the NASDAQ 100. And, if all you were to do is look at this through the lens of just this single factor model, this linear chart, this one-dimensional chart, you would think, yes, everything is good. But trading and investing is all about finding the best value or the best bang for your buck, and that's where investors go. They try to find the best risk-adjusted opportunities. And so I brought a couple charts along for you. One of them here, and I'll show you this one here first. This one is, I took the NASDAQ 100 and I divided it by the New York Stock Exchange Composite Index. Why would you do something like that, Serge? You would do something like that in order to gain perspective. And this perspective has shown us, and again, we've been on the record for this for the better part of the past 4 months, that there continues to be relative weakness in the NASDAQ 100 names. And you can see that ratio. So if you take the NASDAQ 100 and divide it by the average stock, and the average stock here is really represented by the New York Stock Exchange Composite, you can see that the average stock is actually outperforming the NASDAQ 100, or inversely, which is what this chart shows, is that the NASDAQ 100 is underperforming relative weakness of the broader market. And you can see how long and for how many years this has been the opposite. And we do think that we're going to continue to see this. In fact, it's one of our base cases for the foreseeable future, not to see these NASDAQ 100 companies fall apart, but to see relative weakness. And this has major implications. And again, we've been talking about this now for many months. This has major implications for your portfolio, for the average mutual fund that's in equities, for the broader market, particularly the market capitalization weighted indices. Before we continue on this line, let me just show you, for example, the chart of Amazon.com, which really hasn't done anything for the better part of, let's call it, since August 2020. Even actually before then, if you want to look at through a longer term lens. How about Apple? Yes, we've seen rallies and turns back down, but really since August of last year, this stock hasn't done anything. So the question begs, if the broader market is so reliant on these companies from a market capitalization perspective to go higher, and they're not, then what's in store and where's the rotation? And so to show you this in another way is by looking at the NASDAQ 100 versus, say, commodities. Same exact idea. So now instead of dividing the NASDAQ by the average stock market, the average stock, let's divide it by another asset class. Totally different, in this case by commodities. And you can see how many years the commodity complex has underperformed, i.e. the NASDAQ has outperformed the commodity complex, and now the opposite is happening. And it's really difficult to overstate the importance of this. So I would really urge you to keep this in mind and start looking and using ratio charts. Lastly, What's really interesting is that to a good degree, some of these mega cap stocks, and again, I'm not here to badmouth them, it's just, one of the things that we need to be aware of, they tend to do better when interest rates are at least not rising. And we all know that U.S. interest rates have been rising, but I just cut this chart. This is the yield of German 10-year government bonds. And they are still negative as I'm recording this right now, but they're in a hurry working their way towards zero, maybe even going positive. So, this is not just a U.S. phenomenon. You see yields in Europe, stateside, other parts of the world that are starting to get going higher and higher. And I think to some extent, and this is not the only reason, by the way, but to some extent, this is what's weighing on these mega cap tech names. So if it's something that you are heavily weighted in, which most people are, by the way, whether you want to be or not, most likely your mutual funds that you're in or even ETFs are way overweight this stuff because that's what the indices are. Be aware of this. NASDAQ 100 relative underperformance is real. Hope this is helpful. I'll see you again soon.